So what we're doing is like we're joining forces with the Long Island pod. So this presentation is Westchester, Long Island. And Nancy, do you want to speak a little bit about, that?
So the topic actually was broached at the Long Island meeting
Right.
that Alan and Steve were on, and we thought that it was a great, topic. And since they're both in Westchester, we figured it would be more appropriate if the Westchester group hosted it. I just want to say that I don't think there was a lot of publicity on it because I just recently got the information.
Yeah, there was a lot. Yeah. So we'll sort that out, but we're here and so why don't we, I know our time is limited. We have a lot to cover, but we really welcome Steve and Alan to present on this topic. And I just want to, why don't we just get right into it? And this will be a very informal discussion, right? This is going to be interactive. And if there's questions, put in the chat. I'll try to monitor it. And that's it. So Alan and Steve, do you want to take over? And can you speak a little bit about how this kind of began? I know you had that first meeting at the Long Island. So can you talk a little bit about what transpired at that Long Island to lead to this topic?
Yeah, I got roped into it, and Alan will explain.
Oh, goodness. Okay.
So during that meeting, we covered some of these topics, and I thought it would be a really good idea to kind of cover everything having to do with the child tax credits, because over the last few years, when the dependency exemption has kind of gone by the board, we've gotten many different types of tax credits. And I think it's important to really understand each of them, when they're available to us, and how we integrate those into our collaborative agreements. And Steve graciously volunteered on very short notice to put together this program. And I think we're really glad that he's able to do that. I will note on his credentials, we know what CPA is. ABV, of course, we know that's an accredited business valuator, but I thought it might have stood for alcohol by volume. I wasn't sure about that, but Steve can clear that up if there's any misunderstanding about it.
Never,
So
never,
Steve,
never. But, yeah.
Steve,
I also want
checked.
to add that it was the word generous for him to, we kind of like said, Steve, this would be great for you to do.
Well, actually, when you had your session 2 weeks ago in Long Island, I came out a few minutes early so everybody chit chats. And as I showed up, they said, "We just mentioned your name because we have an idea of a thing." Like, what did I do? I just fell into it. That's what I meant before. But I'm happy to do it.
Right. And we didn't leave a lot of time, so we appreciate everything that Steve has done to get ready for this. And I would also throw in the advertisement that we did for this. We didn't mention something, and Steve has talked about this a little. Maybe we can throw in, even though it's not an exact topic, but the Trump accounts we've talked about in our programs having, to deal with the 529s and other college
that is
methods.
on the plan here. So,
Okay, great. So as they say, Steve, take it away.
all right. So I'm going to be doing some visuals for you guys. And I'm sorry, I'm going to start your day by making you start early in the morning by having to look at an IRS tax form, but that's the way we're going to begin it.
Wait a minute. So you need to share your screen.
Yeah, I will. Yeah, I'm
Okay,
just getting set.
okay. Give me a minute because I don't know if we have, we might need to get oh, you do. You have the ability to do it. Perfect. Okay.
We are good. So, like I
Okay.
said, I'm sorry that this is the way that you have to start your morning by staring at a
Oh,
IRS tax form, but welcome to my life. So that's the way it is. I've highlighted some things on here just to get started to show you the importance of having this discussion, because I think a lot of people don't understand that there are a lot of requirements for some things. And oftentimes I find that people just put in their agreements that the husband or the wife will be claiming head of household status, for instance. And you can't just decide that one of them is going to be eligible, will be claiming head of household status. You have to meet statutory requirements. It's one thing to engineer the facts so that you'll meet the requirements and you can bake that into your agreement, but you cannot put in there that the wife will claim head of household status, because that has no bearing at all on how things work tax-wise. So you have to meet the requirements. And to show you that it's become more and more of an issue, that the last few years in the IRS, they've been putting more and more new questions on the first page of your return. And any of these questions on here means that you also signing your return under penalty of perjury. So you're really acknowledging that these are all important things, and that you're telling the truth about it. So there's a specific reason that just in the last year, this filing season, this whole section here with dependents right here has been built out substantially. So all the parts here where I put in highlighting, that's all new, right? And starting actually with up here, giving the relationship, and then answer all the questions below, because they're trying to both remind you what the requirements are and to make sure that you're meeting them, right? And so take a look, like for instance, if your filing status is head of household and you lived apart from your spouse for the last 6 months of 2025, or you legally separated according to state law under a written agreement and do not live in the same household. So they're looking to get those key elements to meet the head of household. So they're reminding you here. So again, if you have it in your agreement, just because you say it, you have to meet these and then check the box. Or also, again, it's very important to understand for some filing status, have you lived apart from your spouse for more than 6 months? So they have this question up here. So a lot of these things that come up in tax, they're really zeroing in on it. I want to show you also, is we're talking about credits now, where ultimately are they going to come through on the tax return? There's some separate forms to claim them, but if you want to look really quick to see if somebody took it in the prior year, the credits are going to flow through here in line 27, the different parts of 27 all the way through 30 is taking a variety of the credits. So you want to be looking at that. Something important also to hammer home and show you how important is all the requirements. And as a CPA, why it's really important. And we have a tussle sometimes, and somebody will come to you and say, in my agreement, the following has been agreed, or I was told blah, 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 and they want you to file a tax return for them a certain way. Well, as a paid tax preparer, we have a specific checklist that we have to complete. And if you don't complete it, or you do it wrong, you could be open to preparer penalties. So if somebody is not a legitimate preparer, they might not care about this, might not put this in the return, but a legitimate preparer will take it seriously. And so there's various questions that apply. Just to show you the various credits that this checklist applies to, there's the Earned Income Credit, that's EIC, Child Tax Credit. There's the Additional Child Tax Credit, which applies in some cases here. The credit for other dependents, they're all kind of lumped together. The American Opportunity Tax Credit, that goes for education purposes. And then this is just to see if you meet the head of household status. So there's a whole variety of questions. So I highlighted a few of the things that are important that you'll find keep on coming up. I don't think we're going to discuss too much the earned income credit. So I'll just say that the earned income credit is for very low income earners, and it's to help give them some support together with various other support programs. One of the most important things is that the child has to be living with the taxpayer for over the half a year. If you're not sure of some of the requirements, sometimes it's really easy just to go to certain forms, and the question that it's asking here will tell you the essence of the things that are important. For the head of household, the thing that's important to them is that whether or not the taxpayer was unmarried or considered unmarried at the last day of the year. So that's going to make sure that if you are married, you're stuck with either married filing separately or joint in most cases. And they want to understand whether or not you provide more than half the cost of keeping up the home for the qualifying person. Right, so these are all important things. So if you take a look at this, it gives you a general idea of what some of the important things are. I'm just going to pause for a second and see if there's any questions or anything at this point, or any kind of comments before we get into the meat of things.
I have a question. I can't see hands raised, so can I just barge in?
Yep.
Can you hear me? Yeah.
Yes.
When you say contribute half the cost, so would maintenance payments be counted?
Yeah, that's
Even
okay.
though you're not,
Whatever funds are in your possession, you can do that. Yeah.
okay.
So Steve, another question is where it's 50-50 in custody and one of the higher earner is paying child support, how does that get interpreted?
Well, thankfully, well, in most years, there's 365 days in a year, so you could actually engineer it though. You try to make it where, because there's actually a situation where if you have more than one child, sometimes people try to engineer it so that you get head of household for both. The only way that you'd have to do this is to make sure that they spend more time with one parent than the other, right? So you have to manage it. That's why I'm saying you can't put it in agreement. But if you set up the circumstances so that they'll meet the requirements, so you always have the tiebreaker who somebody spend more time with. So I think that you can manage it that way.
How do they manage it? So if you have two children, right, and it's 50-50, and one claims one and one claims the other, how does the IRS validate that?
The only way to validate is on audit and be able to prove where you spend time and all. It's difficult, those things. So that's why you need to, I think as a preparer, you're going to want to make sure that somebody have the proper substantiation. It's like many other areas of the tax law where do you maintain any kind of log or record or rather than just say it, right? And so it's difficult that way.
Steve, I have a
Yes.
quick question. How much is the head of household
Good.
credit? Because
Yeah.
how much is it worth, like investing
Right.
in all the perfect language and making sure the parties are coordinating perfectly? For how much is at stake?
Yeah, I appreciate you asking that, Maxine. And that's something that's important to me. I feel that for some of these, people spend a lot of time in something where there's not a huge amount of benefit. People get excited about it, but it's not always something that's big. So in preparation to go over that, I want to show you, I have the slide that was ready to show you. No, I'm in the wrong place.
Steve, hi, it's Carmen. I'm sorry, I'm in the park with my dog. That's why I have my camera off. To be clear, every single one of those elements must be met. So if they haven't lived apart for 6 months,
Right.
then it's off the table.
Yeah, we're going to go into all the specifics in a second. But so to Maxine's question, I prepared this in advance. There's two elements to where the benefit is. And I heard Maxine use the word credit. First of all, head of household is not a credit. That's a filing status. And when you're talking about filing status, the things that are important related to the filing status is one, what tax rates apply to that status. And that's the first and foremost one. Also, what level of deduction, if you're going to go the route of standard deduction, or if you're going to be itemizing instead. So those two things go together. And sometimes, depending on a filing status, there are all different things throughout the tax code where something, a threshold might be 10,000 for state and local taxes, or which now became 40,000 for most people, unless your income is over 500,000. But for married filing separately, it's half of that. So it has ripple effects in other places too. But the main one of the things, and I highlighted this in advance for the presentation, is to show you if you're not going to be head of household, then you're going to be single, right? And so if it's one of the two, so for those where you find yourself in the 10% tax bracket, this is based on what your taxable income is. So remember, the taxable income is after taking off whatever your itemized or standard deductions are. But strictly on the rate schedule itself, the first bracket, as we call it, would be 10%. So that for a single person goes up to 12,400. For a head of household, it goes up to 17,700. So there is 5,300 more, right? But it's 5,300 at 10%. So the savings here of head of household just right here is $530.
Thank you.
So then you get up to the 12% bracket. It goes up to 50,400, and you can see here the head of household is 67,450. So again, it's it is higher, but it's at still a relatively low bracket, and things even up by the time you're at the 22% bracket. Those both top off at 105,700, and the rest of the ride is going to be the same for both of the filing status. So you could go in and calculate, go through these three different levels and say, well, if I knew that my income is greater, my taxable income is greater than 105,700, what's the exact difference in tax? What will it be between the two? So it would be a few $1,000s. Okay, it's not nothing, but I think sometimes I see it at our collaborative table that people spend a lot of time on something where there's not that much, not a huge amount at stake, and it causes all kinds of other problems. And also, people find themselves going through all kinds of contortions to get there. And I think that's part of what you were saying, Maxine, is it worth it? So people have to make the judgment. Now, certainly the case that we have that are lesser means, I think that maybe these are material amounts. In cases where people have 500,000, 750,000, $1 million of income, maybe it's not so important. We don't like to throw away anybody's money, but I don't know if that's the place to be focusing our efforts as far as discussions go. Does that make sense to you? And is that kind of what you were thinking?
Yes, the cost benefit analysis to all of the many, things that people have to negotiate.
Yeah, I mean, the other thing I would say is also the standard deduction is different. So on the 2025 returns, a single and married filing separate, the standard deductions 15,750, head of household is 23,625, right? So there's about $8,000 additional that's going to escape some taxation here or whatever. So again, it's another moderate sum that you're putting on there. So it's how it all comes together. Maybe it would help you for somebody who has in other places, depending on what their circumstances are, maybe it helped them get a little bit more out of a certain provision in the tax code. So it does depend a little bit on your specific situation. But there you have that. All right. So I hope that's helpful to understand it. The most important part of our discussion is I wanted to show you that there's a lot of different rules here. And this is just an example of, we have a lot of reference material that we have to, as accountants all the time. A lot of it is built into our software to ask us a lot of questions. And I know that people don't like it when, as accountants, you probably notice yourself when your accountants are preparing your returns, they might send you a questionnaire, ask a lot of things, and some people get kind of prickly about it. But there are a lot of nuances and things. And it's important to answer these things to make sure that we get it right. So the starting point of a lot of these things with the credits is the issue of dependency and who is your dependent, right? And so there's a lot of different ways you can be a dependent. Clearly, your child, right? So you have a relationship test, but beyond that, there's a question. You have to look at what is their age, right? Are they living with you? Or are they not living with you? So all these things here on just because they're a child, that alone doesn't do the trick, right? So then there's a question: are they living with you? And for the different credits, there'll be different rules that will apply, but these are the basic questions that are being asked. There's an age test, right? Because if you're under age 19, that's pretty clear. If you're under age 24, then there's a question of whether or not you're a student or not. Then there's a whole other issue. You could also be a dependent even above this age if you have a disability. Someone who's disabled and needs supporting them, and that would also extend to somebody. They don't have to be a child, but if you're providing substantial support for somebody for those reasons. The support test also is in providing more than half of someone's support. An important thing is that the child cannot provide over half of his or own support during the year. Also, when it comes to filing tax returns, some of you might have experienced it sometimes. Sometimes we do almost all returns now by electronic filing, and sometimes returns will reject. And a reason for rejection might be that if you were claiming your child as a dependent, but the child's tax return was already filed, right? And they didn't indicate that they're going to be claimed as a dependent, and they indicated they themselves are they're not a dependent, and a different set of tax rules apply to them, then you would have a rejection, right? So you wouldn't be able to meet this support test. So sometimes you have to go back and amend the return that the child did, where you have to live with what they did because there's problems. Probably when that occasionally we would see in our cases where somebody has, excuse me, a sick parent or some kind of relative, and they're taking care of that person. Those people can also be deemed a relative, a qualifying relative for the dependency purposes. I'm not going to spend the time really to go into it. I can certainly share these materials with you afterwards, but just understand that it really depends on, does that relative have how much income does that person have, and do they meet the support tests that we went over before? A whole bunch of different things that come into play. So you can see that there are a lot of nuances here to things. And as a practical matter, as an accountant, I also say that sometimes there's a battle, even if you fully qualify and you should be the one to take the dependent. Not every parent is truthful, and we've seen this come up in cases. But sometimes the wrong parent goes and files a tax return claiming that a child as the dependent. In the old days, when we filed on paper, it wasn't easily caught unless they select that return for audit. Now on electronic filing, there's certain things that I'll look for at the time of filing, and they'll check and see, are there any other returns already that have claimed this person? So aside from the situation where the child themselves didn't indicate that they would be dependent, but if dad went and filed return quickly and made the claim when it should have been mom, well, then there's a problem there. We've certainly seen that. And I want to be clear, it's not, sometimes before people were racing because they want to be able to claim the personal exemption. We don't have the personal exemption. That goes back to it being eliminated in 2017. Not that it was a huge number again, but people want to get the exemption. It does still exist, by the way, on the New York return, but an exemption is worth $1,000. And when you multiply it times a typical New York State tax rate is 6.85%. So an exemption might be worth $68.50. So it's not a huge thing. But anyway, sometimes if somebody wants to qualify for certain things, so they go and try to file and do things quickly. One thing you could do, and I would recommend to people, if they're afraid somebody's going to do something wrong, and there are some cases where you can make it where also somebody might file for the child when so that they can control the whole situation instead of the other parent doing it. And it's a good thing for all of you to do anyway, is to get what we call an IP PIN from the IRS. It's to make sure that you can't have an identity theft, right? But one of the things it can control then is who could file for somebody who can't. And if you don't have the PIN, you can't do it. So if you control the PIN for your child, then you can control what's going on with their own filing. But aside from that, everybody should have one. I use it for myself too, so that if you paid an X amount in estimated taxes during the year, somebody can't come along, quickly file a return at the beginning of the filing period, divert your refund to a different account, and so on. So it's an important thing to have, but it can be helpful in other situations as well. So
Steve, before you move on to the next point, Maxine had a question, I think, that's relevant. Would it make sense to say that the parties alternate years on these benefits, right, the children vis-a-vis taxes, and that if the person happens to meet the criteria, they take it, and if not, they don't?
Well, first of all, one thing I want to say is there's a difference between claiming somebody as a dependent and somebody being a qualifying dependent, so that you can say that your spouse can claim somebody as a dependent in a given year, but you can still do and have household because you have a qualifying dependent. Doesn't mean that you claim them yourself. So there are some nuances there. And I see Ivan has his hand up as well.
I just want to, well, first, before I ask my question, just to get clarity on what you just said. So does that mean that a person who doesn't have the ability to claim one of the children as a dependent in a given year could conceivably still file as head of
You
household?
could have that situation because the key thing is that you have a qualifying dependent. Yes.
Okay, terrific.
Yeah.
Right, my question was this, it has to do with student status. So in the age test section, it says a student under the age of 24 at the end of the year. Um, so it's a student, if they have to be under 24 at the end of the year. Never mind. Answered my own question.
And by the everything in the world of tax is measured by the last day of the year. That's the same thing for marital status and so on there. So this first page here is really, this is all about the earned income credit. I don't think we're going to see that too often, so I'm not going to spend a whole lot of time on it. There's a lot of fraud in that area. So I think that if somebody is going to take it, you should make sure that it's legitimate and you're factoring that in. The IRS and Congress is always trying to rein in for people who aren't who are taking advantage of something that's not rightfully so. So just know that there's a lot of tests. If we have time, we could look into it more, but I don't think that that's where we're going to spend our time. One of the things I want to start talking about is, aside from head of household and the dependents, the child credit, is we are going to also talk about the education credits because those are very important. So here I want to show you what is the filing requirement if somebody wants to be a dependent themselves, right? So you see here, it starts with age, of course, but there's a question of how much income did they have, and then you have to look at, is it unearned income or earned income? So there's for a lot of these things, you can imagine if you go into software, if you look up tools, it's very easy to find these things now, even using AI tools, is decision trees, right? So it would take you a bunch of questions. It's kind of daunting when you look at this to try to figure things out. But if you have something with proper decision tree, then you'll be able to come to things quickly. But so I'm just trying to show you what some of the important considerations are, and every case is different, right? So there's a whole bunch of understand that there's a whole bunch of credits, right? And so how much are the credits, right? So the first one is the child tax credit. A child credit is worth up to $2,200, but it can't exceed the amount of what your regular tax liability. So again, there's two kinds of tax liability. You have alternative minimum tax or regular tax. Most of the time we see regular tax these days, and you can't get more than what your regular tax was, and it's per qualifying dependent child, right? So it's not 2,200 in total, right? But it's for each child under the age of 17, right? This is an important thing, and this is why for a lot of cases too, it ends up being less worth the time, is that the child tax credit begins to phase out when adjusted gross income is 400,000 for married filing joint, and for all other taxpayers. So all other taxpayers means either filing separately as single or head of household, it becomes 200,000, right? So once you get beyond a moderate level of income, you're going to start losing the benefits of these things. They start getting phased out, so it might not work so well. There's an additional child tax credit, just another layer that could apply in certain cases of another $1,700. The key thing there is where it says can't exceed this one can exceed the regular tax liability. That's a fancy way of saying that it's refundable to you, right? So for the child tax credit, it can only reduce your tax, but the additional child credit means that you can get back, even if you covered all your tax, you can also get $1,700 refund back in your hand, again, per child, okay? That's the salient things for those two things. There's also another credit that's available for other dependents, right? For other people that you're helping who qualify as a dependent. It's a whole $500, so it's not something that's too meaningful. This note here is just saying there's a whole lot of information that as far as what you need to have your social security numbers. A lot of people find that they're scrambling to have it or so on. If you have a newborn, sometimes people don't have it, but you do have to have that in order to file it. Just a reminder, if you're talking about dependents, right? So if you have children and then have earned income such as dividends and interest and so on, there is a kiddie tax that applies. That's when they have more interest and dividends and greater than $2,700. And so then at that point in time, then the kids would be taxed at the parents' rate, right? And so then having things in kids' name doesn't really give you a great tax benefit. And so the kiddie tax applies to under 17. I'm only throwing it in there only because it does relate to the same people we're talking about as dependents in most cases. So it's something just to be aware of. And let's move on here. There's also, you shouldn't forget that amongst the other credits, there's also a dependent care credit, right? And so dependent care credit might be if somebody who's watching the kids, or it could even dependent child care credit. It can even extend to situations where if the kids are going to camp. So one of the ones where people get hung up all the time is, can they take a credit for kids are going to sleepaway camp, right? And sleepaway camp, you can't get a credit, but you can for day camp, because the day camp is considered more like daycare, right? And so it's something to watch over the kids during the day, but it doesn't work at night. So there's different things there. And so we're going to use this page to go over a lot of the education, but also first the key things to know for head of household. So who's the qualifying person, qualifying the taxpayer to file as head of household, right? So again, this is going through the whole decision tree. Is asking, is she married and could claim the dependent, not married? There's a whole bunch of different things, and you have to look at what the living relationship is. But the key first thing is, this is talking about the qualifying person who is receiving the benefits to help you be claimed as to be able to claim the head of household. So there's all different sets of rules here that can apply. So it starts to get a little bit confusing. So you have to look at it.
I have a question.
Go ahead, Arnold.
Are people preparing, Steve, or do you recommend that people prepare marital settlement agreements that really address all these various credits? Because I haven't seen that. I mean, it's interesting what you're saying, and I understand the importance. Do you meet the requirements, et cetera? So I wonder if you could speak to that, or people have any forms where they've addressed, this big package of various credits in their agreements.
I have to say for myself, I haven't focused a lot of these credits a lot because I don't know if it's always necessarily always worth the time, and things change. And also a lot of the cases I work on where I find that they're phased out from a lot of things. So it's not fertile ground in a place to spend the time. I think it's important to at least ask a few questions and make sure that there's awareness. And so people, at least they understand, because everybody's going to ask you to, can you put it in there, and I'm head of household, whatever, and explain to them there's certain requirements, that they have an account and they need to speak to them and so on. But just make clear to them some of the real, the basic items about, how long did you live separate and apart from your spouse, and who provided the support, and ask a bunch of different things. It's hard to put it right in the agreement other than just make the conditions where if it comes down to who's providing more of the time and support, whatever, and maybe you can engineer it, but it's pretty tough. I don't know what everybody's practices are.
That was a question I was anticipating, and I'm glad Arnold brought it up. But I don't usually put in my agreements the specific tax credits, but I do address the possibility of the head of household, and probably tie it into their ability to take the head of household. But I think there was an earlier question when Maxine said, could it shift from year to year? Could it go back and forth? So under what I'm saying, I think it can go back and forth depending on changes in where the children spend their
Yes,
time.
I agree with that. Yes.
I don't put it in. I basically have a provision in my agreements that advise my clients to speak with an accountant because there's all kinds of issues, and some if they want to talk, if they want to, some of these issues are relevant in the negotiations, like the custodial period when you want to have one kid, the kid more than half the time. But I don't put those kind of credit. I don't put that in my agreement. I'm not an accountant. I'm not a tax lawyer, and I recommend my clients, consult with an accountant.
I think there's another consideration is that there are some cases where it's better for a child to claim themselves as a dependent, depending on way with phase outs working and so on. And if you make something too rigid in your agreement, you might actually make it such that you're losing out on an opportunity somewhere else, right? So I think that's why it's good to just make people mindful and have just some of the most basic boundaries in there or clarifications, but also understand that rules change. If you did an agreement back in 2014, right, you had no idea what the landscape would be today, right? And so it could be good for you, it could be bad for you, depending what you put in the agreements. Adam. Your hands up.
Thanks, Steve. That's like a really perfect point because like what I've tried to do, not, it depends, but towards Ellen's point, towards your point, I'll say something like I'll write something into the agreement along the lines of, with reference to, I don't know, like this various favorable tax, rule. If one person can get it, great, but if they can't take it, they can give it to the other person. Like, and somehow parties like that, like, we could, if Steve can take it, great. If not, maybe Adam could take it and they can talk about that, maybe from year to year because things do change. And
Yeah,
they kind of recognize that it's already happened to them to some degree in terms of tax filings. So if maybe just, their post-divorce estate can kind of, take advantage of whatever, possible favorable tax provisions there are, that somehow, mollifies the whole situation in a way.
I give an example. Some of you might be aware the last few years, the FAFSA form has changed quite a bit. And some of the things is who's claiming the child and different things. And you could box yourself totally in by what you've done in an agreement. And there's lots of money to be had if you did that FAFSA the right way and stuff. But you're at odds with the new scheme. So that's examples. And so since I said FAFSA, maybe it's a good segue into the education credits, which is, I think, where maybe there's more interest sometimes. And this is kind of where we got into this discussion a few weeks ago out in Long Island Pod, because we were talking about 529 accounts, right? And so if you're talking about 529s, then you also have consideration of various credits that are out there in the world of education, right? So just to be clear, first of all, on the federal level, there are no deductions on the federal level when it comes to credits. So when it comes to education, what you have is a number of credits that have to do with education related expenses. The one deduction there is actually has to do with student loan interest, but that would be on the student level. And so in some cases that might apply. The key thing is the two main credits that you have on the federal level is the American Opportunity Credit. You might see the abbreviation of AOC, and the Lifetime Learning Credit, or LLC. So the American Opportunity Credit is limited to only your first 4 years, so your undergraduate years. The Lifetime Learning Credit, as it implies, is not limited to just first 4 years. You can use it for graduate programs as well. You do have to be at least a half-time student. That's in part why, to claim these credits, students will get at the end of the year a Form 1098-T, and that's where the universities report how much tuition was paid. And there's a box in there that indicates whether you're at least half-time. That's important to be able to claim these things. So for the American Opportunity Credit, it's a $2,500 credit, and it's per student. It's like we went over before with the child credit. It's a per person concept. Some of it can be refundable, some not. So 40% of the American Opportunity credits, that makes it 1,000, may be refundable. The rest of it is just an offset against what your tax is. You can use it for tuition and fees, also books, supplies, and equipment, and undergraduate and graduate study if we're in the first 4 years of post-secondary. So why that's important is that some people are enrolled in some joint programs. You see some where you have a bachelor's and master's together, so it's kind of compressed. So in your 4th year of study, you might already be into your graduate part. So it has to do with the first 4 years of your schooling. And like everything else, and this is why it becomes kind of limiting, is that there's a phase out. So if it's on a joint return, it's 160 to 180 for our divorced clients. Then they'd be talking more about the $80,000 to $90,000 range, because you're not going to have a joint return anymore. So again, it's very limiting. The lifetime learning credit is a similar type of credit, but that's something to be used later on. Generally, you use the American Opportunity Credit first, and then you go on to the lifetime learning credit. It's $2,000, the lifetime learning credit. However, that one is not refundable. Okay, so there's a limit in how you could use it. One of the things that's important, and this is where some of the intersectionality came in a few weeks ago, is that you can't double dip between, say, a 529 and this, right? So that if you paid the entirety of your education expenses using 529 funds, you can't then come along and say, okay, now I'm going to take my American Opportunity credit or my lifetime learning credit. That's considered a double dip. So for planning purposes, what's suggested is, let's say you have a situation where you have more than enough 529 money and you anticipate there's going to be some left over afterwards. And we went over that a few weeks ago a little bit. There are ways to take that money and roll it over into a Roth IRA, ABLE account, a whole bunch of different ways, another family member, and so on. But if you anticipate you're not going to, you won't burn through all of it, but you want to preserve as much as you can, you should make sure to only pay your tuition up to leave enough room so that you could claim the American Opportunity credit and not have to tap the 529. So then those 529 funds are preserved for a later period if you use them. So if you have $100,000 of tuition, and some schools are, they're getting close. So if you had $100,000 tuition, but you knew that you could get a $2,500 credit, American Opportunity credit, so you paid $97.5 out of the 529 account, and you pay the rest out of pocket and then claim the credit to get that money back. So then in effect, at the end of the day, you have more money left in the 529 account for tomorrow, whether it's for education, use it for any of those other purposes. Even if you took the money out of the 529 and paid the penalty, right, you're still ahead because it's money you wouldn't otherwise have had. So even if you have to pay some tax, you still come out ahead. So it's important to look at all these things together. So the box on here just shows you, it makes it clear that is the student claiming the exemption, who paid the expenses, and who could claim the credit. Because in some cases, depending how you do it, only the student could claim the credit as opposed to the parent. So you want to do things the right way. So I'll give you these materials so you could study all. Because if I went through all the minutia for each one of these, we're going to be here all day. But you get the idea. It could be important sometimes is to be careful who's paying it and who could claim it and who can't. So make sure that you do things correctly. One of the things that's important, very important for you guys to be aware of, and the minutia sometimes does account. So what I'm going to highlight here for you is that expenses paid directly to the educational institution under a court-approved decree by a grandparent or other individual or treated is paid by a dependent, right? And so that's important just to make sure that there's attribution, because sometimes money goes to the college, but it didn't necessarily come directly from a student. So is it considered student paid, parent paid, or something else? So that's important, that there are certain rules that speak to all of these things. So I'm going to pause because I'm sure there's plenty of questions here too, or comments people want to make.
This is fabulous so far, really.
Yeah, I know there's a lot of minutia, so I'm saying a lot of things that's on the schedule, but really time wouldn't permit it. But we could even have another session if you want it, once everybody's absorbed it all. But there's just a lot here to take in. But there's a lot of materials out there too. Thankfully, it makes it easy. But I think the goal of a lot of these presentations is just awareness, right? And just the same, if I'm listening to one of the presentations, one of our mental health colleagues is speaking. If I see something and hear something, I know to go to one of our colleagues for help. And I think that's part of the goal here, is to make sure that, in certain situations that maybe you need to get somebody involved to help in some way. And to have some awareness.
Steve, I had a question. Do you ever review, I know you review when we're working with you in a collaboration or in a mediation, the financial provisions. Would you be able to kind of review the tax section of agreements do you do that?
I always do it. Every case I work on, I generally look at the financial section, whatever. And one of my things I generally kick back is when people write in there, I still see it all the time, that husband and the wife will claim head of household status. I said, this doesn't mean anything. It will be disregarded. It's the same thing as when a lot of you do indemnification agreements. I don't have anything, I don't have a problem with it per se, other than I always specifically speak to the client still and say, it's all fine and good, but that's a contract between you and your soon to be former spouse. The IRS doesn't care, and they will go after either one of you. And this only gives you a right of subrogation against the other, right? And so still look at it and just at least let people know whether something works or isn't, or you're leaving something out. Is there an opportunity there? I mean, if I've worked on the case, and I generally know if they're going to be a fit or no fit. I do think some of these things with the lower income levels, and that's why some of these things don't come up as much. But if we are successful in doing the streamlined protocols, and I'm aware, I think there's a fourth case that might be, I believe case number 4 is currently being worked on, because I passed along some notes from case number 3. But I think those are the kind of cases that we might start seeing some of the things where these kind of issues may apply more, because they're more limited means type of situations, right? I think the case that we see a lot more is a question of 529s and who's going to have control over 529 and all that kind of stuff. And I thought we'd get into that in a second when I go over the Trump accounts, which is the last thing. But yes, Alan.
Steve, so this brings up a lot of questions, so that if in an AOC account or lifetime learning credit, the parties are contributing either 50-50 to the education, or there's a disproportionate contribution, you could place in an agreement how they're going to apportion the credit, correct?
How they're going to apportion the credit.
So if one parent is paying 60%, the other's paying 40%, can you apportion the credit 60-40 as well?
I don't know that both parents could claim it. I'm not sure that's the case. I'd have to check on that, whether you could do that, because I think you still, I'm going to have to circle back on that one. I'm not positive.
Okay, that just came to mind.
So I want to switch then to the last thing. We're going to talk about the Trump accounts for a second. And before we go to it, I'm going to ask, does anybody know? And Alan, don't you answer, because we already went over this. What is the form number to apply for the so-called Trump accounts?
I actually had it because I sent it to a couple of people, but I don't have it in front of me. But there is a form.
Well, here it is. It shouldn't surprise you. That's form 4547. Right? Like everything else. It's a testament to the man himself. So term 45 and term 47. So
I think the color might be wrong. The form that I have is in gold.
Easy number now to remember.
But anyway, so if you should have
No,
trouble and you have to look it up, so that's a quick and easy way. So some interesting things on here, which raises a question that could come up in other things too. So these Trump accounts are actually behind it all is very much like an IRA. So the Trump accounts are going to apply for kids who are born between 25 and 28. So basically during his current term, the accounts are going to go live in a few weeks on July 1st, and you're going to have to apply to open up the account. One of the things that we're going to have problems with as practitioners is, or potentially, if somebody's come in and they have a young child and hasn't been applied for already, is that there can only be one account per child, right? Which means there's only one custodian per child. So who is going to be the master of this account, right? And so if somebody, the first one to file it, the first claim to set up the account is the one that is going to be in effect. Now, it might not be so exciting for people to have control over it. They might not care because up until age 18, the money's just built up in there and they can't be used for anything. So it's not like a parent's going to invade it, right? But part of the goal of the Trump accounts is that you're going to put in $1,000 initially. The government's going to put in the starter for it, and then any combination of people. It could be family members. There's some incentives for employers to do things. Whatever, you could put in about another $5,000 a year. There's more and more guidance coming out, so it's not a finished product yet, but there's enough guidance to have some idea at this point. You could put in, say, $5,000 a person. There are some big philanthropies that are trying to put some money into seed into these accounts in addition, like Michael Dell of Dell Computing is now put in enough money to put in some additional money to each of these accounts. But generally, families can put in another $5,000 a year. It's very restricted in how it's invested. You're not really going to have much say, and fairly conservative, but it could build up to be a decent amount of money over time until the child turns 18, if the family has been putting money in there. At age 18, it becomes an IRA account like any other IRA account, but it's at age 18, it's also, you have an issue that it's now under the control of the child, right? And so it's intended at that point at age 18, it's like any other IRA between then and age 59 and a half. If you use it for education, then you have an exception from penalties and some taxation. But if you use it and you can take 10,000 out for a house and so on and so forth. My problem with it is that whatever the 1,000 grows to, let's say it grew to be a decent amount, although I doubt it from the way the initial investments are set up, although they're thinking of opening up to letting it be invested in more interesting things. But if family members start putting money in and it grows to something, and a child's age 18 says, I'm not going to college, I want to do something else, and this is my money, there's enough money in there to go buy yourself a shiny red Porsche or whatever it is, right? I'm always worried when a child has access to a large sum of money at age 18. Some kids are good for it, some kids can't, but parents make that judgment as kids are getting older before they start putting money in. So if you're going to start funding at an early age, you don't know if the child will be able to handle it at that point. But so they can use it for whatever form you want. So some people might decide that this is part of the education planning, whatever this grows to, but it doesn't work the same as a 529 account where you just pull the money out, use it for education. There are all the traditional rules for taxes that come into play. So it may not be important to people whether they want to be the custodian of this, because you can't take the money out anyway. So I'm not sure if it'd be an issue. However, you're also not going to have any control over it at age 18, no matter which parent is the custodian of it. So it's something just to keep in mind. It's be something that's there. I think you're going to get questions about it. I don't know if it's going to be important to somebody to have any kind of control over it or not. So you should be aware of it. Any questions about it or anything you've read and know about it so far?
I have a question, Steve. Why
Yes.
would any parent decide that this is a good way to go if it really is intended for educational purposes rather than a 529? Is it maybe just a supplement to just increase the amount that you could put away for potential education?
No, because I think 529s doesn't have a limit. Some people think 529s have a limit, and that they say on the New York State return you could subtract 10,000 on a joint return of 5,000 on a single and married filing separately. That's only a limit before you eat into your unified your combined gifting and estate tax credit that you have for a lifetime of more than $15 million. It's not a limit. The ultimate limit on 529s is something like 550,000 or something, some number they think with what today's tuition and fees, what it will be at age 18 and whatever it is. There's no practical limit. And so between the two, I don't see what the advantage is, unless you think that at some point going forward, one of the exceptions for, say, buying a house, that's going to help you. But that, when you pull it out of a Trump account, it's only going to be a $10,000 exclusion at that point. Maybe if you think there's some big medical thing that you're going to use it for, but generally, no. And one of the downsides also is you also have to consider, even if you don't use a 529, and 529 is tax-free for use for education, but if you use it for something else, when money comes out of an IRA account, it's ordinary income. If a parent took the same amount of money and just put it in a brokerage account and it grew, right? And then you pull it out, it's at capital gains rates, right? So some people, capital gains rates are 0% up to, say, about 50,000, then you're in a range up to 250,000, about 15% that goes up to 20%. So for many people, the capital gain rates will be more beneficial than ordinary. So that's one of the downsides with the IRA accounts, is taxes ordinary income. So I think, like everything else, you need to understand what the different things are and look at your objectives. So one of the most important things in the world of finance and financial products is match things up to what your objectives are. How much flexibility do you want? We can't always predict what will go on in life, but you have a general plan and see how it works. So there you have it. Any other questions?
I had posted a question, Steve. The forms that you were referring to prior to the actual tax return forms, Fast Tax Facts. I was just looking it up. Is it
FAFSA? You mean I said FAFSA?
No, the Fast Tax Facts.
Oh, the Fast Tax.
Yeah, are those forms from
Are the thing I had on the screen, you mean?
Yeah, is it the taxbook.com? I just want to know where I can get
that
them.
was something I subscribe every year. I get something called the Tax Book. If you can see it here, but I have a whole series of them, and I have it electronic, and a bunch of all these books with every chart and everything you can imagine, whatever. So it's all a bit, it pays. It's a professional library that you have to have. I mean, there's a whole section just on dependents and stuff. So
Right. I just wanted to have my own, not that I would understand all of it, but just as a reference, and then I can call you about what I'm actually looking at.
What I shared you today, I'll send it on to you. I'll make sure that that we post it up. I'll do that part. I will make sure that you have everything.
Thank you.
Thank
Wonderful.
you.
So I'll get it to Melissa, and she'll
Yeah.
send it on to everybody.
Definitely.
Right.
So
Clock
thank
has
you.
struck 10.